Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, March 20th, 2020. This is video number 2 today. First one I covered the equity markets, including the VIX Volatility Index, and in this one I'm going to go through some of the other asset classes. The point of this video is to just kind of do a broad overview, covering the various asset classes that typically you use as for diversification within your portfolio. I've done extensive videos in the past talking about asset allocation. Study after study shows that asset allocation, in other words, the mix of how your portfolio is diversified between those different asset classes like stocks, bonds, commodities, precious metals, that is a more important determinant of your performance, long-term performance, than is actual security selection. Security selection is deciding whether to buy Apple or Amazon or XYZ versus ABC Corporation. So it's an important part of portfolio diversity. However, times are different. I've talked on that lately, and that's why I want to do this video, is really to go over, because I'm sure a lot of you are wondering how to successfully navigate this bear market. We're in a bear market. By all metrics that I follow, it's only in the early stages. We're in the early stages of recession. That won't be official for quite a while, because a recession is defined as 2 contracting quarters of GDP. A quarter is 3 months, so you got to wait till the month is over. After the quarter's over, it takes another month for the government to even come out with those figures. So by the time it's declared official, we'll be knee deep into a recession. That's what I want to talk on today. Very quick update, because the point of this video was to cover everything but the stock market, but I do want to make mention that a couple things here. We've seen QQQ roll over after popping its head above that trend line, but more importantly, I went over in the earlier today, I went over the futures charts. Let me grab it. And there were levels I told you should contain a pullback, and if they didn't, we'd probably drop. And that was 3 things. We had intersecting 3 different intersecting support levels. We had a trend line that we were back testing. We had an uptrend line off the lows, and we had that 72.93 ish support level, and you can see once it gave way, boom, big red candle. So right now, that's not good for the Nasdaq 100. That is a breakdown. Today is quadruple witching, so take everything you see today with a big grain of salt, but I just wanted to point that out for that on the near term. We broke the uptrend right there with, like I said, a confluence of triple support levels taken out. I also gave you the levels to watch for example, on IWM and RTY. Let me find that. RTY, same story. That's the small cap futures. And you can see it, boom, clearly taken out there. Again, quadruple witching. Maybe it'll be a whipsaw signal. That's one thing that you have to take into account, is volatility is usually very high on these days, so it can cause an elevated chance of whipsaw signals. But as of now, take it for what it's worth. You have to take the charts on their face value, and that's it too. There's IWM, that trend line I showed you, solid breakdown, and so could be the end of the run, could be the end of the bounce here. Maybe not. I think it's a great weekend to go into light without many positions. If you want to try to capture more downside in this market, fine. That's like I said, I wholeheartedly believe we have not seen the lows or the end of the bear market. It's just a matter of how much do we bounce first. We've already had a decent bounce off the lows, like I talked about, better than 10% in most indexes, and that may be it for the bear market rally. And certainly with these breakdowns today, that's possible. Now, what I didn't do in the other video, and I'd like to do here real quick, is just talk on the long-term outlook, because again, this has to do with investing, 401k money, long-term money. This is one of many. I have other trend indicators I use, but one of my favorite, well, of course, trend lines are very important. So here was this yellow trend line to me was, and at the time and still is, was the most important in the bull market trend line for the S&P 500. And I had that trend line right here, broken back in the drop of 2018. So technically, you can't say that's when the bear market started, because we went up and we back tested at a higher level. But that's all it was, and I talked about it for a while. The S&P 500 for a year back tested. This is a weekly chart, so this stuff doesn't happen on a day-to-day basis. Each of these candlesticks, my apologies, guys. Let me back up. This is a monthly chart. So each of these candles represents 1 month of trading action. I was showing you the back test on the weekly chart for a while, and that's all it was. So a very simple, chart pattern. Usually when you break a trend line or a bearish chart pattern, one of two things happen. It's one and done, and then you move lower, or you go in and back test the trend line from below, and then, in the fact, when you do have a back test, you might say, well, Randy, that was a back test, that was a back test. When does it? What you look for is an impulsive rejection off the back test. That's usually a tell that that will be the final back test there. So by every metric that I have on the S&P 500, we're in a bear market. However, I should say that's not accurate again. You have to have a monthly candlestick close below your trend indicators and your trend lines, and today is only March 20th. But I severely doubt we're going to see over the next just over next week or so a 16% plus recovery to get us back on or above the trend line and that 20-week exponential moving average. Week, I'm tied up in weeks for right now. I don't know why. 20-month exponential moving average. That's this blue dotted line. Talked about it many times in the past. If you're new to my analysis, it just does a phenomenal job, as you can see, this blue line, of defining bull markets when the S&P is above it, and bear markets when it's below it. That's the dot-com bubble back here. There's the bear market that followed. There was the next bull market. Bang up job of acting as support during the bull market. Once it breaks, you had one chance to get out on the back test after the signal was given. That was your load the boat first bear market rally, get out of Dodge during the great, the 2008 meltdown. If you didn't heed that warning, or the fact that early on it told you, the trend had changed to bearish, then this is what you suffered, or you profited if being short. Now we've had what I call the mega bull market, supersized bull, and you can see some of these we do have a couple closes below, but most of these are intramonth pierces, only to see the S&P close back above or on that trend line. So again, it's done an excellent job. No indicator's perfect. Again, you'll get a whipsaw signal here and there, but this is unmistakable right now. Here's your candlestick for the month. And so to me now it's a matter of we're in a bull market in reverse. It's that simple. Which means in a bull market you buy the dips, sell the rips, and in a bear market you sell the rips and you cover the dips. All right, so when I say sell the rips, you can either sell your longs, or at this point really should be more of the way I'm trading is go back to cash once the rally's run its course, and then go into shorts. Like I said, it's a weekend and quadruple witching, so I'm not going to make any big changes today. And believe you me, I'll be looking for some additional trading ops going forward, and we're going to roll into that now in a second. Just some other things out there, whether they're actionable trade ideas, or you might want to know, hey, Randy, what about corporate bonds? What about government bonds? Because in your 401k, 95% or more of your options are either going to be stock funds or bond funds. You're going to have a stable value money market fund. You're going to have various stock funds, international, U.S., small cap, large cap, mid caps, but they're all stock funds. And in a bear market, just like in a rising bull market, all ships are lifted with a rising tide. The opposite happens in reverse. So you can go buy Procter and Gamble all day long, or Clorox, all these name brand companies, because they're supposedly all weatherproof, recession proof, because people still need them. Guess what? They get sold down with the indexes in a bear market. Most of them, again, there's a few exceptions along the way, but for the most part, there's not a lot of places to hide. And what makes this bear market different, which I'm about to roll into, I believe, over any point in time in history, is there's really no place. That's why I'm doing this video. There are places to hide, but not the usual suspects, which I'm about to roll into in a second, which are Treasury bonds. But before I leave this, I just want to make mention that QQQ, here's that 20-month exponential moving average. Phenomenal job of defining that bull market back in that was the biggest bull market up to the time, that big run up to the 2000 highs. There's the dot-com bubble, the ensuing bear market. It said get out and stay out right here when that crossed below the 20-month. Told you it was safe to get back in the water here. That's a bull market. Might not look like much, looking at this crazy dot-com bubble and the huge bear market after, but it was a powerful bull market, and the trend indicator worked great. Started to crack right here. That's when it broke at that point, and had a little kickback, and that was it. And there's the drop meltdown in 2008. Again, it doesn't look like a lot on this scaling because we had a mega bull here and a mega bull here, but that was a 55% drop. So don't let that little blip fool you. And this, again, the trend indicator told you that was bear market territory back there. And right now, so where are we at? Where am I going with this? Boom, 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 boom. Done a great job as well, but it's cracking. It's under there right now. The month is not over yet, so we'll see how it closes. But I'm a betting man and by nature for what I do, stock trader, and so I'm betting whether it's this month or almost certainly in the next couple months we'll see that. Probably most likely this month. Again, we'll just see where we close. But we're also below a very clean and clear bull market uptrend line. The Nasdaq, unlike every other index, bottomed in late 2008. Everything else bottomed right here in March of 09, but we also have a reaction there on that trend line and a lot of reactions along the way since. So that's it. So by nearly all metrics, we've entered a bear market. That'll be solidified here at the end of the month when these weekly candles print. Monthly candles. And now let's move on and talk about everything else and where to maybe move some money into and where maybe not to move some money into. Okay, what I've been saying, and I've been saying for years, when we got to this point, when we got to the next bear market, would make this one different from most others at different points in time, in which, man, I hate to say it, just makes me so much longer term bearish than the last time around. The last time around, I did a really good job of navigating the bear market. It was very profitable for me. And, things were, although the system broke, that's where things started to get wonky. The Fed came in with their grand experiment, which is why we're seeing such, big crashes today. Keeping rates too low for too long. That's why we profited twice in the last month. Two very profitable quick trades, especially when you figure out how quick they were on shorting investment grade corporate bonds. Again, nothing like it in history. I'll get to that in a second. This drop. Why is that? Well, because the Fed kept the pedal to the metal too long with rates too low and allowed every company and their brother, all these marginally, rated companies to go out and refinance and sell a lot of debt at these super low rates. Everybody took advantage of the low rates, including corporations, and so you had too much at that low end of the investment quality there. So we'll get into LQD in a second. I've talked about that extensively. So we're going to start here on bonds, and if I have to wrap the video up and end it with bonds, I'll do that, and then break the next one down into currencies and then commodities and gold. But let's try to talk fast here and get through this. All right, this is a very clear chart to me. Forget about the lines here. Just look at the price action. This is a textbook buying climax. It is a parabolic advance in treasuries leading up to that high. Everyone flocked into treasuries. And this is what happens. I've said this many times over the years. Parabolic runs typically do not end it very well. They don't just correct and then let the hot air out. When you have a parabolic run, it's usually a near vertical drop afterwards, and that's what happened in Treasury so far. Now, where they go from here, I've made it very clear, and this is what makes it different at any point in time in history. Interest rates are on at the bottom of a secular bear market. When I say a bear market in interest rates, this is the 30-year Treasury bond. So these are the rates on 30-year Treasury bonds measured here in basis points. And we hit near zero recently. And there's nowhere for the 30-year to go down. The Fed doesn't control this directly. They control the very short-term rates. But basically, nobody's going to take negative 5% on their money, or even really hardly any negative rates, to lock it up for 30 years. And safety in treasuries are losing their slowly, and I think maybe more rapidly, losing their place. If the king of safety, flight to safety assets. Because what's going on right now, again, everything is unprecedented. I know I use that word a lot because that's everything that's going on here. The rapid shift in the macro fundamentals of the economy. You have states and countries shutting down, going on lockdown. I talked about that this morning. I'll get to this one, talk about municipal bonds. I told you that California's, their economy is so large. It is, I told you it's one of the largest in the world. It's now the fifth largest economy in the world by itself. That's one state. The California is bigger than just their economy alone, bigger than the United Kingdom, who has fewer residents than California. I talked about this. Everyone's talking about, whoa, wow, what the impact it's going to have. The entire country of Italy is on lockdown. Well, guess what? Italy is not a fraction, but it's considerably smaller. The entire country of Italy is their GDP. That's how you measure the economic output, is much smaller than just the state of California alone. So where am I going with this? This is the trend we're seeing. Now, California just, declared a state of emergency and put everybody on lockdown. Yeah, they're not going to police it right now, but they are, restaurants, businesses, a lot of businesses are shutting down. Imagine the impact. So if you think, and again, I've said this, if they came out with a cure today, tomorrow, yes, the stock market will explode. You'd see the most explosive rally you've ever seen. But I feel very strong that the technical damage is done. When the wheels are set in motion for a recession, it is a domino effect. People are laid off. People lose their jobs. Those people stop spending. They have to tuck in. They don't have the income. They go out, eat out less. They buy less goods and services on Amazon and other things, and discretionary spending, and then it just has a trickle down effect. And like everything else, you can go back in history as long as you want. Recessions are just going to have to run their course. They're as natural as the seasons. After spring comes summer, after summer comes fall, and in the financial markets, after an economic expansion comes an economic contraction or recession. And so that's it. Anyways, I just wanted to point that out. And of course, New York just did something similar, telling all workers to lock down, stay at home. Okay, so back to the charts. I'm probably not telling you anything you don't know. I'm sure you've seen the headlines. And again, the trend is still at the point where it's getting worse, not better. So the end is nowhere in sight. But like I said, there'll be, and there has been, a temporary floor in the markets. And remember, today's triple witching. It wouldn't surprise me if to see we had a big intraday reversal after a big overnight gain. We could see a big intraday reversal to the upside now. But again, that's just kind of noise. And like I said, trade it as you want. I gave you some levels earlier, and so far those levels, once those support levels are broken, they did trigger pretty sharp wave of selling. But this chart again, I'll put on my lines. There was a price channel, and the yellow lines are the price channel there. Here, I'll draw them out for you here, and I just want to talk on this because I think it's very important. So, this is back here, Carter years, Reagan, interest rates peaked back in the early 80s, and there was a very clean, well-defined price channel that interest rates had been walking down. And again, this is what we call a secular bear market. Within there, you have cyclical bear and bull markets and rates. And remember, these are interest rates. They move exactly opposite to bond prices. When interest rates go up, the price of a bond, Treasury bond particularly, will fall. That is an immutable, pretty much an immutable relationship. That correlation has always existed. So what you've seen is Treasuries, and TLT doesn't have a charting history because they didn't have ETFs back in the 70s. They had mutual funds were even young at that point. So you need to look at the actual bonds. Now, so what has happened is, this was where the grand experiment came in. We had a nice clean channel, as I had it drawn here, is actually this price channel, and see something wonky started happening when the Fed started, just messing with the status quo. Things have been around for hundreds of years, and came in with this massive, unprecedented intervention. Not just the Fed, all global central banks, and it took prices out of that price channel. We snapped back into it, continued to go, but more rounds of quantitative easing had kind of just busted up the charts, and now you can see this is their all-in, and now nowhere to go. This is virtually to the bottom. And so the point that I'm making, and I've made it repeatedly lately, is unlike any other point in history, even back in the financial crisis in 2008, the Fed doesn't have any more room. There's no more downside to go from where we were just, again, recently. We just came off the top, so I'm not speaking literally from today, but I'm talking of where rates just peaked, the long-term rates. There's really not much more downside. On top of that, we're coming off an extended period of ultra-low rates. So what impact What positive impact is it going to have to continue to lower rates? You tell me what business out there, what individual, who do you know that's had a mortgage for the last 20, 30 years that hasn't refinanced at this point and is going to do so now? Sure, rates are going to be a little lower. They should be. I don't know. I haven't looked at the mortgage rates. By this, they should be, but sometimes that doesn't happen because the banks are blowing up right now. And when the banks blow up, meaning their stock prices are collapsing, they have to rein in the belt. They can't lend money out at the start of the most, at least the way we're heading, the most rapidly developing recession we've ever seen in history, because we've never again seen a shutdown in the economy like this. So you might think, oh, well, these low rates could be good for the housing market. No, not if the banks aren't going to lend money because their capital requirements are stretched, and they have to then tighten the belt. They don't want to start being more lax after the economy's collapsed, because they're not going to get that money back. So they're going to be more stringent unless the Fed really forces their hand or really pumps them full of so much capital they don't know what to do with. And that's what the Fed's trying to do. So I'm talking fast, I'm rambling. These are fundamental things, but it's bad, bad, bad. The system is really, we don't have what we've had at every other point in history. When the economy entered a recession, the Fed started a rate cutting campaign, and that pulled it out of eventually. I'm a believer, look, the low rates certainly help, but again, I'm a firm believer that the market ebbs and flows in cycles, expansions, contractions. It's growing over time. And they're going to run their course anyways, and the Fed has always been, behind the curve anyways. They start cutting after the turn is in, and they usually stay too easy for too long, and that's why you get these, at least in recent years, these crazy swings and these bubbles that they created, like the housing and credit bubble back in 2007, and the one that just popped now. So anyway, back to TLT. Will there be some tactical opportunities, meaning, in and out? Yeah, sure. I showed you on ZB the other day a downtrend line target that I had, and that was hit. Got it somewhere on my chart here. This is a ZW. I'm looking at wheat. I'll get to commodities in a second. I have so many Z's down here. This one is Treasuries. Boom. That was that trend line hit. And you bounce, and then you come up, and now I'm going to give you another trend line here to watch. That'll probably check ZB, and then an uptrend line. So here's how this stuff works. If you're a treasury bond trader, that's it. Here's your next opportunity. You're running into resistance. You can either short at resistance and or on a break of this trend line, and that probably starts the next downtrend. If we can take out this uptrend line, then you still want to watch this trend line for a break, and we might hit this price resistance level, but we'll probably do something along these lines here. Okay, and so quickly, so how much more upside, if you're wondering, because what you need to do, if you're using this analysis to figure out what to do with your long-term funds, for example, your 401ks, read the description. You don't have to read through the entire prospectus of your mutual funds, but if you have bond funds in there, read through what percentage are investment grade bonds, of those investment grades, what percentage are treasuries, and what percentage are corporate investment grade bonds. I've already given you the downside, the pitfalls to investment grade corporates, which treasuries don't have that same those same conditions. But however, what treasuries have right now is when is the world, and I think that's what we've seen here already with this huge drop. When is the rest of the world, because we have a lot of foreign buyers, as many other countries, Japan, China, hold a great deal. A lot of countries hold a great deal of US Treasury bonds. When are they going to say, hey, look, the US is writing checks like they're going out of style, checks that they are not going to be able to cash, they are not going to be able to pay for. The only way they're going to pay for this tremendous amount of stimulus, the airlines want huge bailouts. Everybody's going to have their hands out asking for bailouts. All these businesses laying people off, people out of work, unemployment rates, unemployment claims are going to spike. Everything go down the line, food stamps, welfare, all that's going to go up. They've postponed tax filing now to June, I think, if I'm not mistaken. So there's going to take a big delay on the tax receipts, which really help keep the wheels going. What I'm getting at, the only way out of this mess, the U.S. Fed's going to have to print money, and making money out of thin air, selling bonds to pay off the existing bonds as they come due. And what happens is people know that is basically, yeah, they're not going to get their they're going to get their money back in dollar terms. But you put 100 grand into a Treasury bond. That's the minimum amount to buy an individual Treasury. Are you going to get your money back when that Treasury comes due? Sure. The Fed's always going to make, but again, the way they can do it, unlike corporations, the Fed can just print money. A corporation can't. A corporation runs out of money. They don't print U.S. dollars. You're going to get, they're going to go bankrupt and not pay you, and that's why LQD has some, different, circumstances going on. So, all right, let me just tell you. So your upside. Let's just say we make another run at those highs. That's about a 14% return. So that is certainly a possibility that there is some upside in the near term, especially if there's another big drop in the market. You could very well see a flight to treasuries because, again, there aren't a lot of places for individuals or institutions to hide. If we head up to that next resistance, that's about 7%. I can't make a compelling case to go long, nor would I care to go short. We already hit this trend line resistance right here. I'm just standing aside treasuries for now, is what I've been saying for a while, at least the last few weeks here. There's, again, tactical trading ops. Might take CB short or long, but that's not going to be an official trade idea, at least not anytime soon on the site. And here's a weekly chart. On that blow off top right there, it put in, it's not confirmed yet, but looking like it's going to put in a big divergent high, negative divergence, and remember that we already had a pullback to this trend line. So those are your key levels to watch. You have 149 price support and trend line support here, and again, even if you sit in treasuries right now, the best you're looking at is capital preservation or maybe a little capital appreciation. The interest rates are paying next to nothing, so you're not going to collect hardly anything worth. People aren't buying them right now for the yield, for the income, because there's hardly any income there. All right, so that's it, and let's look at a couple other type of bonds. Okay, and what I'm doing is I'm walking down the spectrum of credit quality. So you have treasuries at the top, again, considered the safest bonds actually in the world, because the U.S. has always been, kind of the world's reserve currency, and best, our house has been in, the best or close to the best financial order. Again, like I said, I have my concerns now with U.S. going into recession, with the Fed not having really any tools left to fight it. Just print money now, print more and more money, which again can backfire on the bond market. So the next one down there is LQD. If you haven't heard, my thoughts on it, you want me to expand, just watch one of the recent videos. Those trade ideas are both closed out, so it's actually, although this video is for subscribers only, since those trades are closed, they're now open to the public, as all closed trades are on the site. Completed trades, that is, official trades. So the story on this one, as far as our trades go, we traded this with near impunity. We shorted right here in anticipation of the breakdown when it was still on the trend line. Caught all that move right down, that initial run down right there, hit our third target, which was set just above this 116 level right there, closed out, and then waited to short back on the bounce right here, again at 120, just shy of that former second target there, and then swung it down here and closed it out. And as I said, there's a very good likelihood it'll turn out to be a runner trade. I think there's a lot more downside in the near term. The longer to intermediate term, due to all the reasons. And what I had talked about, just to kind of recap it, is in recent years a massive and unprecedented issuance of investment grade corporate debt that was at the lowest tier of investment grade ratings, triple B. Any bonds, triple A is the highest, then you go double A, single A, and then triple B. And then anything below triple B, a double B or below, is considered a junk bond. Below investment grade. And the problem with LQD and all the mutual funds, such as those in your 401ks, by prospectus, they can only hold investment grade bond if that's what they say. Or maybe in your 401k, your mutual fund might say it has to hold at least 80% investment grade. So whatever that number is, when all these, and I believe, and it's probably already begun and will certainly continue, a massive amount of downgrades from triple B to double B, which then causes those funds, those bonds, to have to be sold or jettisoned out of mutual funds and ETFs like LQD that are only supposed to be holding investment grade bonds. Okay, no big deal. They get rid of the junk, Randy. What's the big deal? Well, number one is even before they get downgraded, the market, smart money, knows it's coming, and the price of those bonds plummets in anticipation of the downgrade and the fact that the fundamentals for those companies are drastically and suddenly over the last couple months just took a nosedive. Meaning, well, what does that mean? Well, a bond is an IOU. It's just like your friend or neighbor saying, "Here, I'm going to loan you $100. I promise to pay you back." That's what a bond is. Stock is different. Stock is equity. It's ownership in a company. A bond is simply an IOU from a company. When you buy a bond, they're promising to pay you back a certain rate of interest as long as they have your money. And when that bond comes due, they promise to pay you back all your principal, and that's how it works. Now, an IOU, as you guys probably know, is as good as a person or entity you lend it to. If you lend money to your neighbor that you've known for 30 years and you know he or she will make good on that money no matter what, then you have a pretty solid guarantee. That might be your AAA rated or AA rated bond. You lend it to that gambler that just has an addiction, goes down to bets the ponies every time they get it. You're probably not going to get your money back. That's a junk bond, and so that's what's going on here with this. With these bonds. And the big problem is in a normal working market when you don't have such a tremendous stack of the investment grade bonds at the bottom of that low end spectrum of ratings, then economic conditions change, business cycles ebb and flow. You can go back in time, and sure, there's a little adjustment, but obviously LQD didn't do great back then. But those bonds get moved out. Right now, this is a fire sale, a rush for the exits, and it's happening very fast. You can see even faster than back in 2007. Remember, this is when the last stock market topped. Last bull market ended was October of 2007, so somewhere along probably about right here. And so corporates started going down, 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 down. This is months later. They didn't plummet like this till late in the bear market when the financial crisis hit. This is the start of the new bear market, and I think it's going to be an ugly one. So again, not a place to hide. Will there be bear market rallies and snapbacks? Yes, but I don't even expect them to be that strong, or at least very long lasting for a while, because again, such a crowded rush for the exits, and I'm not the first one to point out the fact of this huge issuance there. I read it from sources elsewhere. It's been going on for years now, but what I did do is apply technical analysis to figure out, and fundamentals, knowing that, hey, the stock market's tanking, this is all about to start playing out, to nail the timing on it, because those that warned about it and have been bearish and trying to short corporates for years, they were annihilated on this last run up. So it's all about timing, and that's where technical analysis and fundamental analysis merge and work really well when those trades line up. It's not always. This was a once in a lifetime opportunity. And again, there are going to be kickback rallies. The risk reward, I closed that trade out officially because it's not very good risk reward. We fell to the bottom of this trading range, which is where that second target was set, that last target. This is that multi-year trading range. We are below it now. And I expected, I thought the odds would be good for a bounce, and this could be a little momentum fueled overshoot if we get a little reprieve in the stock market and or the corporate bond market. We could run up and maybe bounce and then go down, but over time I think there's more downside to come, and I'll tell you, it'll be extremely bearish if that's it. We just slice right through the bottom of this trading range. That's very good support around 111, as if it wasn't even there. If that's the case and we don't look back, then yeah, not good. So my point is, okay, where am I going with that? Not a good place to hide out. If you want to time a tactical trade in LQD or your 401k, I can't make a case to do it right now. We are coming back, and in fact, we're about to back test the bottom of that channel. There's your last target there. It was set around just above that 111.24 level, 111.38. Looks like an objective shorting op, because it's going to come back and kick the bottom of that multi-year channel from below. There it is. So that's my take on that. So far we've gone over kind of my long-term view on the stock market, which I don't think is a good place to be. On Treasury bonds, well, like I said, near term I'm neutral, but longer term, again, the upside potential is very, very limited. I showed you what the upside potential was on capital appreciation if we get back to those highs, but if they're not going to just go there and get pinned there. It's possible, but the downside risk if Treasury bonds have turned the corner now and hit a major top, and let's say they start going down in price, and rates start going up because of that one worry that I have, and I've also read that others have it, that individuals and corporation or investment firms and countries around the world aren't going to be so keen to buy treasuries if our house is not in good order, our financial house is not in good order, which, like I said, this is not. There's nothing you can spin positive about the economy right now. We're heading into recession at a time where Trump, of course, blew up this market. I'll just let it all out here. This was big criticism that I had and others. If you really know you study history, and talk about the tax cuts. The reason this market soared back in 2016 after he was elected, he pushed through tax cuts. The only president to do this. Tax cuts historically have been reserved, just like rate cuts with the Federal Reserve, for in times of need. When the economy and the stock market is growing, and we were in at the time almost at that point the longest economic expansion ever in history. We've then since exceeded it. That's not when you do tax cuts. You do tax cuts here, back when a bear market and a recession starts. When you do them here, just like the Fed getting too easy for too long, you now have burned up a lot of your ammunition. Because at this point, can they do deeper tax cuts? Sure. What's that going to do? Balloon the federal deficit. Revenues are going to drop off, income tax revenues during a recession. That's just a guarantee. Business and individuals make less money. And that is a time where you need to do tax cuts, but you've already initiated all these tax cuts across the economy. Can you do more? Yes, but you're going to pay for it. That money just doesn't come out of thin air. So that's my concern. We're going to roll into the next thing here in a minute, which is a US dollar. I know I'm still talking, and we're long into the video. So I already gave you stock market, treasuries, investment grade corporate bonds, and now the other one of the other types, which are junk bonds. Let's just keep it simple. Junk bonds trade in line, much more so in line with the stock market than they do with the bond market, the rest of all the other kind of bonds, municipals, governments, treasuries, investment grade corporates. And the reason is they are corporate bonds, but because these companies they're that neighbor I talked about, or friend that has a gambling addiction, they're on the verge of either staying in business or not staying in business. They're low credit rating, and so what that means is during recessions, the default rate on junk bonds spikes. These companies don't have the cash flow any longer. They go out of business, and you're lucky if you get any of the principal on the bond back. Some companies go out and there's nothing left over for the shareholders or the bondholders at the end of the day. Maybe they get 80 cents, 50, 30 cents on the dollar, but they're going to stop paying the interest on those bonds, and there's a good chance they're not going to pay back the principal. So that is a certainty. Go back as far as you want in time. JNK has only been around since the end of the last bull market, but you can see what happened there. 50% drop. It dropped just about almost exactly what the stock market dropped. The stock market went down 55%. Now it's about the same, and you can see, boom, we're off to again an unprecedented start. Last time the stock market, stock market peaked back in October 2007, just before JNK. Maybe HYG was out before then. HYG is the other big junk bond fund ETF. There it is. So there's your right there. That's about when the stock market topped, and this is how the last bear market started off. Look how this one's starting off. Different times. If that's the beginning of this bear market, I hate to see what this stage is going to look like if and when that comes. So in summary, will there be bear market rallies in HYG? Yes. Will they be very profitable to trade if you get it right? Yes. I can't make the case to do it now. Just like the stock market, by nearly all metrics that I follow, this is only the beginning of a bear market with more downside to come. So again, it's another one that I think that you want to stay away from for the foreseeable future, and that's let's just call it the foreseeable future, whether it's weeks, months, or years. Let the charts and the fundamentals dictate things. I'm wide open to anything. Believe you me, I'd love to hear more than anybody, or as much as anybody, hey, we have this vaccine now, or all of a sudden the virus is just abating. The number of infections has gone down, yada yada yada, and see everything rally. But again, it would take a tremendous amount of upside in the junk bond market, in the stock market, to change the technical damage that's been done at this point. So there's another non-option, if you will, to put your money away, in my opinion, for the next year or two, if you're looking, where to hide out in this market or profit from the next market. Okay, another long video. I figured it would be, because there's just so much. I get talking about this stuff, and I talk about the charts, I talk about the fundamentals, I talk about the inner workings of the financial markets, the relationships, and all this kind of stuff plays in. And at the end of the day, I may be wrong or right on my analysis. I tell you, what I'm seeing now, where I think we're going now, and again, hopefully you find some value in this, as to, again, where to put your money, and I think more importantly, where not to. So at the end of the day, and I'll say it again, cash is always an option. I'm going to get to, in the next video, I'll cover gold and the precious metals, and with that, I usually wrap in the euro and the US dollar, the currencies, because they have a big impact on gold. And I already kind of talked a little bit about, some dark clouds on the U.S. dollar. It kind of goes hand in hand with those comments on the Treasury bond market. What impact our spending does. But again, the dollar is tough, because as much as we've increased our deficit here in the U.S., the reason the dollar has been in a bull market for years now is because we were the best of the worst. If that makes sense. In other words, that's how currencies work. Everything's relative. So, the U.S. dollar, if our financial house is in better order, if we have higher interest rates than the ECB, the euro, because the euro is the biggest component of the dollar index, then the dollar is going to rise. However, if things kind of flip, and all of a sudden the fundamental outlook and our interest rate picture goes down, we close that gap, which we've done recently, that's net bearish for the dollar. But again, next video, because there's other factors than that come into play, such as the recent shortage of US dollars in a financial crunch like this right now. That's what's caused a recent surge in the dollar. We'll study the charts and then talk that through in the next video. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.